YouTube, which is kind of funny. And you're uploading.
Mr. Beast isn't really that better than us, so we can go that one.
Yeah, okay. All right. I think technically, I think we're all running. You're uploading. We're live somewhere. I don't even know where this is exactly live. But when people see this eventually, or maybe hear this, I don't know if this audio is going out as a podcast format too. Probably should. I think
Probably should.
it's not very evergreen.
Live on your radio, local
Live,
radio station.
listen. All right. Well, if anyone's tuning in or listening later, welcome. This is a special edition of the Dentist Money Show. And today, what's the date today? Just for reference, April 7th, 2025. I have Robbie here with me, and fan favorite. And I'm Ryan. Thanks for joining us. Robbie, why are we talking today? What is going on right now? And anyone who's watching this now is going to be like, thank you. What's happening? We're dying to hear from Robbie. That's what everyone's going to be thinking. If they're listening to this in a year, what is happening right now? What is going on? Why are we having the discussion we're about to have?
Yeah, we always try to find, opportunities to chat with our clients. So we're happy about this.
Yeah.
Kind of because of a certain market panic that, as fiduciaries, we thought, let's have a conversation. Let's clear out the storm and let's sit and think about this for a second. To just give you some historical background on what has happened in the last 3 to 4 days to get everyone up to speed, everyone on the same page. The new administration decided to take a new stand on their fiscal policy. And fiscal policy is what the government does related to the economy and to the money in the country. It controls taxes on domestic citizens and controls kind of taxes on foreign entities that work with the U.S. It also decides on how much it wants to spend on, big government projects such as Medicare, Social Security infrastructure, or if it decides to not spend on these. So the decision on how they want to run that cash flow is related to fiscal policy. The new administration decided to impose tariffs, which is an import tax on any import bought by American citizens on foreign products. Everyone has opinions, of course. The government says that
we'll just report facts. Yeah, we're just here to report facts.
And what I mean by everyone, I'm talking like the stock market has its opinion, the citizens have their opinion. So from the government's perspective, they're saying that if we impose this import tax called a tariff on foreign goods, we will be able to raise some money. And that will help us with our budget deficit that happens every single year. The U.S. as a government spends more than it earns in tax revenue. So that might help us, and that might also level the playing field internationally to allow or prompt or incentivize companies to start their production within the U.S. and hopefully start producing in the U.S. and make the U.S. as a whole more competitive on the global scale. Because kind of now, in the 21st century, we are more of the customer of the world than the factory of the world. So this is where they stand. This is the government. This is the opinion of the government. There are paths economically on pen and paper that this, if you follow up with other strategies along the way, this might be good. But there are also paths that this might, honestly, you'll just hit a hard wall and it'll be bad for the economy. Companies, on the other hand, which represents the stock market. So when we're talking about the stock market, we're talking about companies, what business leaders think, business leaders who are making a decision about where to allocate their profits so they can sell more product and increase their share value, think that those tariffs are going to be a bad idea. And they are taking the perspective that those tariffs from the government are going to make prices higher on the US consumer, reducing their purchasing ability. And because of that, the consumer will have less money to spend, and for businesses, this means less profit to be made. So in a sense, they are anticipating that the economy is going to slow down because this is a higher cost on customers. Why also the customers? I don't know. We're going to keep spending. We don't have a say in this.
I was just going to say, yeah. I think we just keep spending. Yeah.
The last point, the last perspective out of that, we looked at what the government thinks, what businesses think, what the poor us consumers think. And then we've got the foreign entities, foreign governments. Foreign governments say that this is, I forgot the word, but more of like raising the bar, creating more tension, unprovoked. We don't need it. The economy
Escalating? Is that the word?
Escalating is the word. Thank you
Escalating.
so much.
Okay.
I forgot.
Yes. Yeah.
So they think that this is escalating and creating tension globally that is kind of unnecessary. And because they don't want to feel or show their constituents in their countries that they are getting bullied by a foreign country imposing tariffs, they wanted to retaliate, whether it was going to like the World Trade Organization filing a claim, or deciding to do nothing, or deciding to impose tariffs back, and what we would call a trade war. Because now you're saying, if you're gonna tariff my products, I'm gonna tariff your products, and let's see who breaks first.
Do you know my favorite book as a child from Dr. Seuss was this book called The Butter Battle Book? It was about these two neighbors who were arguing over which side of the toast to butter your bread, up or down. And they kept building weapons on either side of the fence, these two people, bigger and bigger and bigger and bigger. So it just reminded me of the Butter Battle Book. I loved that as a kid.
How does Dr. Seuss's story end?
I don't remember. I think I think their weaponry gets so ridiculously out of control that they eventually just go, "What are we doing? Let's just go back and eat our toast the way we want to eat our toast." Now I'm going to find out tonight. Anyway, yeah, an escalation of tariff wars like the Butter Battle Book. That's right.
Exactly. So if we observe how the stock market behaved on Thursday, Friday, and this Monday, we see that the panic came in different stages. The first panic was Thursday after the Wednesday night. We saw the president holding a big bulletin board with different rates, and the market sell-off on Thursday was because of that. And then on Friday, overnight, because, different time zones, China decided to retaliate, and retaliated as big as the slap of tariff that the US introduced. And the panic on Friday was a result of the escalation that happened from the Chinese side. And then actually, today, on Monday, the US was, compared to the previous 2 days, was doing much better. Like, we only dropped around 1%, less than 1%, compared to the other 2 days where we dropped 5% to 7% on them, depending on what index you're looking at, etc. But today, on Monday, Asia took a hit. China is down like 10%, Japan is down 7%. So kind of the Monday today is their Friday. Like what happened to us on Friday happened to them for today on Monday, which tells you that overall this is affecting everyone, and it's not affecting anyone positively. Even gold, which appreciated when Thursday and Friday, actually started depreciating back again, because it's getting to a point where we think this tick for that type of retaliation at a fiscal level is just going to slow down the global economy as a whole.
Okay.
This is where we stand.
This is where we stand. Here's a quick question. I think I would wonder, and people do wonder, every time there's something in the economy or markets or news that is recent, it feels worse. There's a thing with human beings called the recency bias. It doesn't downplay how any of this feels or what it means, but we do tend as human beings to feel like current events are way worse than anything's ever happened before. The word that usually gets thrown around is unprecedented. The phrase that gets thrown around all the time is, it's different this time, it's new this time. What's the history of tariffs in our country? Am I throwing a curveball in there?
No, this is very, I thought, this is going technical, just heads up, But
that's okay. You're the guy to ask.
Really, really good. Actually, pre-Great Depression, most of the revenue the government made was due to tariffs. And they decided to increase tariffs a little bit, which caused a panic, just like we're saying right now. But the difference back then is that the Federal Reserve did not know what they were doing, which made the problem worse, causing the Great Depression. So the Great Depression did not really happen because of tariffs, but tariffs were part of like preparing the environment. Failure, the inadequacy of the Federal Reserve back then is what caused the tariffs. So
100 years ago, we didn't know as much as we know now. Yeah.
But then, of course, the World War brought a fair share of tariffs along the way for obvious reasons. And then, interestingly enough, when the U.S. decoupled from the gold, we call it the Bretton Woods Agreement in 1971 with President Nixon, what was happening back then is that the U.S. was running a trade deficit. We were in a budget deficit, and we had other countries that are really competing against us, running a trade surplus, aka Japan. And part of the decoupling decoupling the US dollar from the gold came along with it with a batch of tariffs. That later on goes inflation of the 1970s that did not really end until the economy was forced down into a recession by Volcker, which was the chair of the Federal Reserve during the Reagan administration, resetting the economic cycle in a sense, getting rid of inflation and letting us ride again. Could this be the same thing? Are we going to head into a global recession or a point where inflation will just start going rampant again and we will have to brute force the economy into a recession to reset the clock? It's possible. But here's the interesting part. Aside, it's really good that we have the history because now we learn from it. We've seen it before. But I ended with where we stand right now as that we are at probably the beginnings of what what market participants think is a global recession. Well, this is not the first global recession what we've faced. And out of all the times we could have a global recession, this is probably one of the best times to have a global recession. The economy is still strong, unemployment is still low, and most importantly is that the federal interest rate is at 4.5%.
Yeah, it's not zero.
We have a cushion of 4% that if they decide tomorrow to go from 4% to zero overnight, put inflation aside and the craziness that inflation might bring, but you would jumpstart the whole planet in a second. So we still have tools at our disposal that tells us that yes, maybe there are uncertainties coming right now, but from the perspective of the economic rubric that we have so many tools that 3, 4, 5, 10, 20, and the longer you go, the more confident you become that we're going to be in a better position.
Okay. Thanks for the rundown. It's funny. Sometimes I start sidetracking myself, going a little mental side quest, and I start asking questions, and I'm like, oh, sorry, Robbie, is this a curveball? And then I'm like, nothing's a curveball to you. It's like you do this for fun. So thank you for going through that. Here, okay, I'm going to list a few questions that I have. I think you're going to hit all these things as we go along. Some questions I have, I think people would also wonder, are things like, how does the recent drop in the stock market compare to historic drops? How common is the drop that we've seen? Some other questions might be, what about the speed of that kind of a drop? The recovery from a drop like that that's really quick? Probably, so maybe some historical data around, how often markets go down 10, 20, 30%, how often they crash. We can talk about that. You don't have to answer that now. These are just things that if you're going to cover them, want to make sure we're going to do. I'll pause there. Where do you want to take this from here?
Yeah. Let's answer this question. We can hit them one at a time, and I think they'll all relate together if you don't mind. Did I lose you? My connection.
Yeah, so the question is...
Okay.
Oh.
No, I can hear you.
Yeah, if you're live,
Go ahead.
Can you hear me? Good?
Yes.
Okay. Yeah, I think the connection's going on and off. Robbie, by the way, is just like, where are you? Are you at the university right now?
Yeah, I'm at the University of Utah. I just finished one of my courses, and I could not find a spot inside because all students are trying to study for their finals. So I'm sitting outside, but it's great weather. Looking at the mountains gives you some perspective,
It's beautiful. So, yeah, if we go in and out here, Robbie's connection, he's just, no big deal. He's just outside the University of Utah at his PhD program, just catching up with us.
If the internet goes bad, it's not related to the market.
Yeah. Okay. Well, let's hit that first question that we were talking about. How common? How far have we dropped as of right now? And it is kind of funny to say like this year, as if the market just resets every January 1st. It's kind of a funny thing to think about. But how far have we dropped? How common is it? And how often do markets do stuff like this? That's a question I think people want to know.
It's so funny that you said this year. While we are, at the low year to date, actually the high was February 17 for the S&P 500. So we had a good month and a half and a change before it started going down. But I'm going to tell you year to date numbers instead of trying to like pinpoint where the highest point was.
Yeah.
Okay. So for the S&P 500, going until, April 7th, today's numbers, we are around 15% down on the S&P 500. We are in correction territory on the NASDAQ around 20%, and we're also down around 21% on the small cap stocks. Dow Jones, which tends to be a little bit more value-oriented, conservative-oriented, doesn't fluctuate as much, is down around 11%. And then you've got emerging markets that are down 8% for the year, developed markets that are only down around 5% for the year. You've got bonds that are up 2.3% for the year because people flock in terms of in times of panic, and then we've got gold that's up 13% for the year, which also makes sense. It's typical textbook reaction. People are fearing, they go to safety. That's strong currencies such as the U.S. dollar, Japanese yen, Swiss francs, goes to bonds such as treasuries, U.S. treasuries, and also head to gold. These crashes are very usual, very normal. Shout out to Matt. He says 10% drop happens as often as your birthday. A 20% drop,
almost annual. Yeah.
A 20% drop happens usually every 5 to 6 years, and then a 30% correction happens every decade.
Yeah.
And these numbers are totally fine. If you tune out the news and you just look at the data as itself and how big of a drop it was, we see this very often.
It's usually slower. That's why everyone's.
I'm gonna actually hit on that. I don't really think it was too fast.
Okay. I like.
In my recent experience either at Dentist Advisors during COVID, I can say I think it was the 22nd or 25th of March 2020. That day, the S&P 500 dropped 12.5% in one day. It was the second largest.
I remember
decline.
where I was standing going through that.
It was the second largest decline. And actually, interestingly enough, to be able to control the integrity of the markets and be able to process all the trades, regulating bodies in the US decide to have a circuit breaker, just like the one for electricity, whenever a stock market, crashes really quickly. That circuit breaker is usually triggered at a 7% drop, and then later on it's a 10% drop, and et cetera. This crash, what we saw in 2 days, a 10% drop in 2 days, didn't really trigger any circuit breaker, whereas during COVID, I think it hit it 3 or 4 times. So that is one. The largest ever decline in the stock market happened on, I think, October 23rd, 1987. It's called Black Monday. And the Dow Jones dropped 22% in a single day. So in terms of the distribution of these drops, yes, it is above average, but is it so bad? Not really. If you follow the markets, it's not really. And the last thing I want to hit, which is very, very interesting, is that, okay, so the market dropped. How many years of savings have I lost? Like when the COVID crash happened, I think we lost 3 years of savings. Like what I mean by 3 years of savings, the drop was so severely downwards that the last time it was at this price, it was 3 years ago. So all the time in between is lost savings in a sense. They did not go up in the market. So in COVID, it was like 3 years. In 2008, it was 10 years of loss.
Or like
savings.
3 years of progress would be another way to put that. 3 years of progress, or
3 years of progress,
increase
3 years
or something.
Of compounding.
Growth.
100%. So you're not losing your savings. You just didn't make any money on them. This is what I mean to say.
Yeah.
And this one that just happened is only around 13 months. So, okay, 2024, I didn't earn anything on it.
Yeah.
But that's fine. If I've been a long-term investor.
If it ended here, if this is where it stopped,
we do not know, but it should not be a concern whether it keeps selling off a little bit more or decides to revert track. I understand that people are afraid because of the uncertainty, but I think the fear stems from because we do not know how policy will evolve, not because we do not know whether the markets will still function as they usually do or not. I have total confidence that the markets will evolve and still function efficiently. We still do not know what fiscal policy is going to do, but that's fine. You've got a whole constitution and checks and balances and, reactions and elections coming up. And so people are incentivized to get stuff working well at the end of the day.
Tell me react to this statement here. Something that I've talked to a few clients about lately is I think that the most prevailing human tendency in the whole no matter whatever happens. I mean, COVID was such a shocking thing to happen. We not only were there, health and safety concerns worldwide, but everything was actually shutting down. No matter here's what I'm saying. No matter whatever happens in the economy or the world, I feel like consumers, we just still want to keep buying stuff at all costs. Like, what was inflation 2 years ago? 9%?
Yep.
we as consumers, we just want to keep shopping, and companies want to keep making money. And I think those two things prevail at almost all costs in all conditions in all environments. I mean, we as a country didn't spend tremendously less money over the last 5 years in any of these environments that have happened. Disneyland just keeps increasing their ticket prices to astronomical, and it's packed every day. Like, we're traveling, we're spending, we're buying cars. It's almost like the most prevailing human condition is like we just still want to keep growing and doing, and companies want to do the same thing. What's your reaction to that?
Yeah, I have to highlight though that this is an American characteristic, not a characteristic.
Oh
of the
yes,
rest of the
and that's
world.
what I'm speaking to. I've been out of the country 3 times this year alone, and that's yes,
The
that's
rest
exactly
of the
right.
world, especially China, since the end of COVID, have been struggling in instilling this confidence in their constituents to like, it's going to be all right. Just spend your money. Let the economic
And they're like,
wheel
no,
turn.
we're going to simplify and save money and
We're
hunker
gonna
down
sit
and just see what
save
happens.
And panic, and
Yeah.
that might not be good overall.
Our government's like,
because-
open credit cards, lines of credit, get loans, do
True.
everything you can to spend money.
It is.
Yeah, that's
and
us. Yeah.
Actually, while that on an individual level might be problematic, right, from a financial planning perspective, on a country level, that is really good because the economy is simply the economic wheel turning and the
Yes.
final value of these goods and the services that we're paying. So yes, Disney is increasing the ticket prices and we hate it, but in the economy calculation just tells you that the economy is growing. You don't want them to increase too much because that's inflation, but you want them
Yeah.
to slightly increase it, maybe 2% a year, you know?
Sure.
And why is it so important that, you know, if the US consumer keeps on spending, that tariff, yes, might be, you know, a little nudge, but it's not going to derail the economy because
Yeah.
the economy is 70% US consumption from us. We are consuming. If you add, so the government is around like 8 to 10% of the economy. The consumers are like 70%, and then businesses are like 18% of the economy.
Okay.
So
All
we're
right.
like we're all like if companies keep doing what they're doing and try to maintain their margins, and
Yeah.
consumers keep doing what they're doing, as in keep saving what they have to, but spend what they and enjoy life what remains,
Yeah.
the economy is still going to keep running and growing,
Yeah.
and all is going to be fine. And actually, part of the bet of this administration is that, yes, there is an import tax coming in called a tariff that might increase prices by 20% on Americans. They are addicted enough to consumption that they're going to keep doing it, but also their balance sheets over the last couple of years have been strong enough that they can weather an uptick in
A
their
price increase.
spending, depending on which quintile you're in. But yeah.
Yeah. Okay. So thanks for pointing that out and clarifying that. I have some more things I want to say, but let's take it where you want to go. We'll go another 10 minutes or so here. What are the things that you want to clarify and hit? I maybe have a few financial planning perspectives, things that we're getting from clients, and maybe some things I would share that our advisors have been telling people. But what do you want to hit? What's still on your plate?
That's exactly what I know. I'm
Okay.
here to answer your technical questions.
Oh, good.
But what I'm interested in is because, like, Ryan, this is not your first rodeo. We all know that.
I'm in year 17, man, of Dentist Advisors. I'm old.
And that speaks loads. So this is not the first time you got clients who are panicking, because I understand that clients would want to get some clarity about the technicalities and
Yeah.
where economically we stand. And I'm
Yeah.
saying it's fine. We still have tools at our disposal. But if you say that, the fear is not going to go away. The fear is more
No.
behavioral, is more emotional. And
Totally.
they want to hear it from a good, trusty advisor friend. How do you navigate this? If
Yeah.
all of our listeners are right now your clients, a big portion are,
Yeah.
what do you usually tell them?
Yeah. You know, the first thing and I've been on the phone since the end of last week and over the weekend, and I'll just say this is just my little tiny sampling of interactions. I've only had I've only had 3 discussions since last Thursday with people who are concerned enough to say, "Can you get on the phone with me this weekend?" Which I'll gladly do anytime. Message I would definitely give to people. I would want people to know first and foremost that we're not downplaying their emotions, and just because we have data or history or we have, some phrases like buy the dip and, markets go up and stay invested and we're in it for the long haul. Those things are not meant to downplay someone's emotions. People's fears are totally valid, and it is part of the human condition to feel like the current news is scarier than anything that's happened in the past because we've survived the past and we've made it. I mean, it's wild to think that people, I mean me too, like we as humans, we're more scared of a tariff worry and uncertainty than COVID shutting down the entire globe. But it's because we made it through that, like we survived that. Is that survivor bias too? That's part of it too, maybe? So anyway, first thing I would say is your feelings are totally valid. Being scared and worry is totally valid. In 17 years of doing this job, I cannot think of a single year when people did not have something to worry about in the economy, the world, the politics, the markets, the rates, something. There has never been a single year when that hasn't been the case. There's always something to worry about. And, as an investor, I think, and these are maybe the tough love things to say, but as an investor, these drops are part of it's a feature of the program. It's not a bug. It's like you said earlier, the drops that we've seen are right in line with averages and how often they happen. They might have been fast. They might be for new reasons. But it is a feature of investing. And it is completely true that the people who stick through these things and keep saving money are the people who gain more wealth over time, because this stuff's just going to keep happening. 10% drops, 20% drops, market crashes. They're just going to have a new news story attached to it in the future. But we're going to keep doing this stuff as long as the markets are alive. And the other thing I want to validate for people is the first question people have on their minds is usually, can we just get out, wait for it to get worse, and then get back in? I'll answer that, but how would you answer that question? And by the way, that's the most natural question in the world to ask, because it seems like the bad news and the get out point seems so obvious just from the feels of it all. How would you address that question?
Actually, I've got family members, my mom, my cousin, who called me yesterday and asked me that exact same question.
Yeah.
Because in their mind, like,
I'm sure your phone's blowing up. But
it's like they're like, you're looking at your account and you're seeing something going down, and in your mind, the way to eliminate that pain, if I let it stop moving, which means I sell and it won't move anymore. But if you do that, you exit the market and you miss out on the rebound. Actually, going to data, the largest days, like upswings, happen very close to the days where it swings down and crashes.
Yes.
And that's due to the market's overreaction. The market, yes, it is efficient on the long run. It reflects prices and earnings.
Day to day?
Day to day, it's
very
irrational.
emotional. Yes.
So it overshoots on the downside and the upside. So you don't want to, exit right after the downshoot and miss the upshoot. So, and this is where like a lot of behavioral training has to come in to stay disciplined and stick to the point. I know that people feel that they have to do something to feel in control, and sometimes the advice of let it ride the wave is too much, but there are other stuff that you can do that are much better than deciding to sell at the low. And here's where, like, we come in. And it's really case by case and depends on the type of clients. For some clients who are continuously contributing every single month, for example, who have lost on this year of compounding, as we just mentioned, that's a great opportunity to do tax loss harvesting. For clients who, are early in their investment journey and they have cash on the side, we can work with them to actually take on more risk right now to be able to them feeling better 10 years from now. And for other clients who are withdrawing money, because they are in retirement, there are amendments that you could do right now to immunize or fluff your portfolio a little bit better to weather the storm. I know that people would want to do something to feel in control, but it's really case by case scenario, and it depends on your investing life stage. Yeah,
great answer. There's a statistic, tell me if I'm getting this wrong, but it's something like if you, in any rolling 20-year period in the history is U.S. markets, if you miss the 10 best stock market days in any 20-year period, your returns are cut in half over time. Did I get that right?
Yes, because those days are so big compared to a normal day.
How many trading days are there in a year? Because this is what's insane to me.
252.
252. So 10 Oh no. Let's go 252 times 20. So that is 5,040 days. And if you missed 10 out of 5,040 days, that is 0.19% of the days. So if I did that right, that means that if you missed 0.19% of a 20-year period, your returns could be cut in half. And just piggybacking on what you said, if you are a person who doesn't need your money right now, you're in your career, you're still saving, you have cash flow, you have a job, you have income, you can't afford to exit a market and perhaps miss even a handful of those days. 10 days out of 20 years is shocking, kind of. And, here's the other thing that you hear a lot. We heard a lot of this after '08, and there's different reasons for it, and it's very unfortunate. But what happens behaviorally to investors when they exit a market during these times of high emotions and panic, and they just get out to have control and to stop the bleeding? What it feels like. Most of the time, they never get back in. Because what happens is when markets rebound, and they happen so sharply, as you said, the news that we hear while markets rebound, they don't correlate. It's still usually bad news while markets are shooting, like a rocket ship. And so what happens is people get out, they wait for news to get better, but they've long missed the upswing by the time news ever gets better by a long shot. And then they never get back in because then they're like, now I have to wait for the next dip because now it's too expensive and I can't get back in. So then it's like a graveyard of former investors who got out, sat in cash, waiting for the moment and missed the moment. They knew they missed the moment and then they never did anything again. And it's actually a gigantic problem that cuts people's wealth in, it reduces it so bad, so much. And so
that's a greater loss than the market, than the crash itself.
So much of a greater loss than the crash itself. So yeah, I mean, these are just the stories that the news might be new or different or slightly different, but it's the same lessons repeated over and over and over. And if you are a person who's older, later in life, accessing your money, needing your money soon, that's where a financial plan comes in, because you shouldn't be investing money that you need to access soon anyway. Or you shouldn't, no, let me say it, you should invest money planning to access appropriately, knowing that you're going to access it soon. So that's a financial planning question too. So, okay, I think those are the main questions. So to recap, a client asking like, I don't need this money. This is my long-term plan. Oh, here's another question, Robbie. And then maybe we can end on this one if you want. Yeah. Some people want to know, if I have a diversified portfolio, let's say an international, globally diversified portfolio of 10,000 plus different companies around the world, can my account go to zero and then never come back again?
If Earth does not exist anymore.
If every company in the entire world simultaneously goes out of business and nothing is ever created in its wake, and they do it at the exact same time, then yes, that's true.
Yeah.
Yes.
At that point, money doesn't matter.
Nothing matters. Well, I tell my clients, like, I won't even have a cell phone company anymore in business to call, so you can't even call me. There's no cell phone companies in business. There's no gasoline companies. I can't drive anywhere. I'm just going to ride my bike to the beach and paddle out into the ocean and disappear, if that's the case. That's my plan. If every company goes out of business in the whole world simultaneously, the world's over. Best of luck. It's been good knowing you. So yeah, I think that's a big question people ask, and a diversified portfolio will help you weather that and prevent it. However, there are so many horror stories of investors who hold very concentrated positions in a portfolio, 5 stocks, 10 stocks, 1 stock, and it did go to zero. Some privately held company. That absolutely can happen, which is why diversification in your portfolio and investment planning is the solution to weathering, bad markets and good markets. So anything else you want to say about that at all?
No, I love it. This is one of the main fundamentals of investing, just like, having the proper attitude during crashes is one of the fundamentals. Mm-hmm. And in this time of uncertainty, all we have at our disposal as humans is stick to these time-tested fundamentals to weather the storm. We can't afford to navigate left or right, because as you just mentioned, missing the best days that usually happen after a crash could be even worse than the crash.
Yeah, thank you for that. Anything else you want to say? Any parting words at all?
Parting words would say is that whoever's listening to us, whether you're a client or not, please reach out. We're here to help. This is part of our job.
Yeah.
And we're happy to answer your questions, and
Yeah.
we're happy to address your specific concerns. I know, these are general principles that don't apply to anyone, but we're happy to help you navigate your own financial plan.
Thank you, Robbie. I don't think I'll make any advisors mad by speaking for everyone on our team, but times like this, I know myself and I know our the other advisors because I hear their stories. They'll get on the phone after hours. They'll get on the phone with you over the weekends. They'll answer an email. We care a lot about making sure people are making good decisions for their long-term health and wealth, and so reach out for sure. Robbie, thanks for joining us from the university on a short notice. And thanks for everyone for listening and tuning in. If you have any questions, reach out, dentistadvisors.com, email your advisor. Thanks, everybody. Thanks, Robbie. Have a good day.
Take care.
Bye-bye. Okay.
Did
Upload
mine
complete.
upload?
Upload complete.
There you go.